acquiring failed regional bank First Republic, leaving the door wide open for the Federal Reserve to hike once again as the GOP challenges the Senate to pass their own debt limit bill. We begin with the big issue. We have a deal. JPMorgen's Jamie Dimon winning the bidding to acquire First Republic Bank following an emergency government-led intervention. The bank will take over First Republic's assets, including about $173 billion of loans, $30 billion of securities, as well as $92 billion in deposits. This is the fourth time an American bank has failed in less than 2 months, and once again investors are asking themselves, is there more to come?
The bank that was caught by the friendly fire.
What's fascinating is that banks can fail while their loan books are performing.
We have a lot of questions that are hanging out there.
There clearly is something systemic here.
There are certainly more troubled banks out there.
The question is whether or not it's only within banks that interest rate risk has been mismanaged.
We know there will be a lot more bank regulation following.
This doesn't really seem like it's a cliff. It seems like it's something that's going to come in, in terms of dribs and drabs.
What we're left with is the Federal Reserve with a tight monetary policy in place.
Today, a lot of the assets on banks' balance sheets are yielding 3.5%, and they're funding them at 5.5%. That is a losing proposition.
We're seeing a tighter lending environment coming up.
This financial stability issue, of course, has changed things.
Ongoing stresses in the banking sector are something we need to worry about.
Joining us now to discuss Bloomberg's Sonali Basak. Sonali, we have a deal.
We do have a deal, John. It was somehow weeks in the making, somehow days in the making, and we're looking at First Republic now. There are things that are sweeteners that JPMorgen does get in this deal, although it is certainly a deal that they are buying for a song still. Now remember, FDIC is providing $50 billion worth of fixed rate 5-year financing, and JPMorgen is not assuming First Republic's corporate debt or preferred stock. Now that is the deal for JPMorgen, along with the details that you had said about the loan book and the deposit base being acquired. But then remember, also there's this broader issue, this burning question for the system at large. JPMorgen said the systemic risk exemption was not required. Now, was it needed, and would the government have stepped up if it needed to get to that point? That is now an open question for the market, and what does this mean for the broader banking system? We know that First Republic in its kind of final days faced some significant flight when it came to its deposit base in its own right. Now, do we face more issues in the banking system is, again, an open question. JPMorgen can't do this multiple times, though they did come out on top in this bidding war.
Sonali, wonderful.
About this deal, perhaps about the insight that they have in saying that this is pretty much near the end of it when it comes to some of the distress in the smaller banks.
Well, listen, the market likes it, and I think one thing that JPMorgen had done here to kind of stem some of the fallout was two things. One, this is a deal that is closed. It is done. It is seal, signed, delivered. The other thing about this deal is that they're paying back the deposits to the other firms. Now, does it heal the safety and soundness of the financial system? JPMorgen is unlikely to do a deal like this twice. What happens after this? The fact that the systemic risk exemption was so unclear up till this point, I think that leaves a big open question, Lisa, about what would happen if more banks were to run into trouble. There's a roadmap now on how to resolve these issues, but again, if this were to happen again, what is the saving grace when we know that this took weeks to settle out?
Sonali Basak, thank you so much for that insight. A roadmap for the path ahead when there is another situation like this, which includes the potential for less lending, which includes a potential risk to community banks that do run into trouble. And this does raise some questions for the Federal Reserve, which meets tomorrow and Wednesday, coming out with a decision on how much more to tighten monetary policy, raise rates in the face of ongoing weakness. Joining us now to really give a sense of what the risk reward is for a Federal Reserve, the balance of risks at a time of inflation that is coming down but still incredibly high. Joseph Lavorgna, Chief U.S. Economist at SMBC Nikko Securities. Joe, wonderful that you're joining us here on set. I'm wondering, from just a high-level perspective, what is the impact on the economy from failures of banks that have left the biggest banks in America, assuming the smaller ones even bigger and not going to fill in some of the lending?
There are two key things, Elisa. Number one, this problem resides with the Federal Reserve. Management issues exist in banks, no question, but this Fed raised rates much more than the forward guidance suggested. They put those rates way above where the market suggested last summer they were supposed to be, based on the inversion of the yield curve. In the banking system, the lending system doesn't work when you have a higher short rate versus a longer rate. The yield curve, not just as a predictor of recession, but causes recessions. And the sad thing is the Fed is going to now regulate these smaller, medium-sized banks when it was Fed policy itself that caused this crisis. That's number one. Number two, given the tightening in lending standards we saw in January, before this SVB Signature Bank First Republic situation rose, banks were already tightening lending standards, small, medium, and large banks at the fastest pace since previous recessions. So I can imagine that when we get the data a week from today, Monday, May 8th at 2, it's going to show further tightening in lending standards, and that is unambiguously bad for the economy.
So you just said a number of things that I want to dig into, and I'll get to the Fed's and sort of how quickly they raised rates in just a minute. But if you're saying that they raised rates so quickly that the banking model did not work, then what kind of follow-on effect do you expect in other regional banks, even though a lot of people say they have been fortified, they have raised capital, they have addressed some of the issues?
Well, that may be true. So there's two issues really. So one is systemic, like how many other banks perhaps are behind the banks that have had troubles. We don't know the answer to that. The Fed has backstopped these banks through these various lending programs. The issue, though, is will these banks make loans and extend credit? That, to me, is unlikely to happen. In other words, they're going to call in deposits or call in loans, try to raise deposits. Revolving lines of credit won't be extended. That's bad for growth. So whether there is another systemic issue because of, let's say, bank mismanagement, we'll call it with quotes, is sort of irrelevant in the sense that what the Fed's already done from a monetary policy transmission mechanism is they basically killed credit and money and lending creation.
New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio with your equity market virtually unchanged. Alongside Lisa Bramwitz, I'm Jonathan Ferro. Anything but unchanged about the financial industry in the last 6 weeks or so. JPMorgen winning the bidding to acquire First Republic in an emergency government-led intervention over the weekend. Lisa, this stat right here, this coming from our team here at Bloomberg, for just over 1 month, SVB was the second largest bank failure in US history for just over a month, because that title now belongs to First Republic.
At a time when people are still saying idiosyncratic, people are still saying this is a resilient system, this is something that is going to be contained. This is the real issue. What does this mean in terms of what the FDIC itself deemed the country's bailout culture, and what does this mean for other banks that they say will inevitably fail because that is part of a healthy ecosystem of a capitalistic society?
Does this feel healthy over the last couple of months?
I think that pretty much everybody would say no. Nothing about this has seemed healthy, especially because there were banks that were not hedging against interest rate risk. There were banks that were extending loans that didn't require any kind of interest or down payments for 10 years. That is a concern.
JPMorgen up in a pre-market, seemingly the markets believe this is a healthy deal for JPMorgen. We'll return to that in just a moment. On the S&P 500, unchanged on equity futures through most of this morning off the back of some of this. In the bond market, yields higher by 3 basis points on a 10-year, 345.22. The euro slightly negative here, Lisa. Euro dollar down by about 1/10 of 1%, 110.10.
A massive week ahead. We've got the Fed, we've got the ECB, we've got a slew of earnings, and we have on Friday jobs report. Today, quieter on that front. We do get some earnings from Avis, MGM, Norwegian Cruise, just a sense of where the consumer discretionary is at because it has been outperforming. The annual Milken Institute Global Conference is kicking off in LA. Interesting to hear what Jane Fraser of Citigroup and former FDIC Chair Sheila Bair have to say about what just transpired in the banking sector, whether this was a good deal that the FDIC struck. And at 10 a.m., the latest with respect to data ahead of tomorrow's JOLTS information. We get construction spending for March and U.S. ISM manufacturing for April. Do we see some sort of, I don't know, green shoots of a recovery there, John?
Looking out for the data going into payrolls on Friday. The big story for us this morning, JPMorgen taking over First Republic's assets, including about $173 billion of loans, as well as $92 billion in deposits. Michael Schauer, CEO of Marketfield Asset Management, joins us around the table. Michael, what do you make of this one this morning?
I think it was the most likely outcome going into Friday. I mean, the rumours were heavy that JPMorgen would be stepping up and buying this, and the sort of mix of risk and opportunity is similar to the way that Silicon Valley Bank, was sort of parceled up and Signature Bank had been parceled up. I mean, I think for JPMorgen, they probably look at this as a way to expand their wealth management relationships. and they probably have a big enough balance sheet that they can absorb the interest rate risk and the mismatches which existed within First Republic.
How many banks need to fail before we stop calling this idiosyncratic?
It's a good question. I mean, it's not only how many, it's, what's the size of them. There clearly is something systemic here. I think the question is whether or not it's only within banks that interest rate risk has been mismanaged or whether there's a general problem. I mean, there's an awful lot of private sector credit. This time around, there's been an awful lot of use of leverage, for sort of general business purposes. Most of it was off floating rates. I mean, my concern is not so much the banking system, which looks fairly solid still. It's more whether or not, the dramatic change in interest rates over the last 12 months starts to really make itself felt in general business conditions.
Payroll's Friday, Apple earnings on Thursday. We've got to start with the banking sector in America. Laurie Calvasina joins us now, head of US equity strategy at RBC Capital Markets. Laurie, does that deal over the weekend put this issue to bed?
Well, let's hope, John. I mean, we've been watching the KBW Bank Index performance very closely. We think it's become as important of a sentiment barometer as anything else that you can look at these days. And I think when we go back to the financial crisis, when we go back to the tech bubble, we look at things like WorldCom, Bear, Lehman, Enron. What we know is that the problem children in any crisis have to settle down before the market can settle down itself. And I think that if you look at that index, that bank's index, it's been trying to stabilize. It's remarkable the resilience that we've seen. We know that earnings revision trends in small cap financials, which is a good proxy for regional banks, have been absolutely smoked. And that's something else that we really need to see happen in here before I think the market can be content with the idea that the pain is out of the way. So time will tell, John, but I do like what I'm seeing in the data.
SVB failed in March. The equity market rallied. First Republic was essentially going under in April. The equity market rallied. Laurie, can you make sense of that? The fact that we seem to have left behind the KBW Bank Index and the broader S&P 500 has carried on grinding higher.
Well, there's another child that the market's paying attention to, not just its problem child of the regional banks, but its, sort of oldest, stellar child, the tech sector. And the earnings there, I think, are in a recovery process. If you look at the rate of upward revisions, another good proxy for earnings sentiment, it got absolutely smoked last year for the TIMT space broadly. And it's actually in recovery mode this year. We're seeing things get less bad. We've even seen the tech sector briefly enter upward revision territory. And frankly, John, that is just the child that matters more to the market right now. It's just bigger in terms of its market cap representation. So the structure of the S&P 500 is in such a way today, and this is very different from what we've seen in the past. But if tech is behaving well, it also pre-traded the pause essentially, and is looking ahead to rate cuts. We can debate, whether or not that's going to actually happen. But basically, the recovery, the improving trends, and the positive interest rate dynamics for the tech sector have been enough.
Well, it's not just the tech sector though, Laurie. As you know, you've been tracking the earnings. And even in some of the consumer discretionary areas, you've seen consumers absorb higher prices. They have absorbed going around the world, traveling as much as they possibly can. At what point does the fact that even these bank failures that we're talking about not tighten credit enough to really do the work for the Fed, and that comes in as a potential surprise for markets this week?
Well, look, I do think that the Fed is likely to go ahead and hike later this week. That's basically priced into market. I think for the Fed to not do it at this point in time would spook the markets more than helping it. But I think that you have to always go back to the reasons why the Fed is doing what it's doing. And if the Fed is saying, okay, we can go ahead and hike one more time, we think this is a relatively contained implosion, we think that the economy is strong enough to go ahead and do that, that is a vote of confidence for the here and now. Now, I do agree with you that we're seeing a tighter lending environment coming up. I was listening to Bloomberg earlier this morning and liked what I heard one of the analysts saying about, this doesn't really seem like it's a cliff. It seems like it's something that's going to come in, in terms of dribs and drabs over the longer term. I think we have to go back and ask, what is sort of the state of the consumer balance sheets coming into all this? And I think the resiliency that you're seeing in terms of that consumer spending speaks to the fact that so much of a mess was cleaned up during COVID from all the stimulus programs and all the time that people were forced to spend at home. And that strength is now coming in, and it's an asset and a buffer for this economy, and it's showing up in those consumer earnings results.
Is the best way to play this in large cap companies and not necessarily the Russell 2000 that's more exposed to other banks that, as Charlie Munger said over the weekend, could be laden with some of these other bad loans, or at least underpriced loans based on where interest rates currently are?
I think, we go back to these crises that we saw in the past. If you go back and look at, sort of the big growth stocks back in the tech bubble, it took a very, very long time for those to become a leadership area again. And you can say the same things about the banks coming out of the financial crisis. So I think it's right to have some caution there. We've moved to a neutral on the financials, and we say that in small cap as well. They're cheap, but who the heck knows how cheap they actually are. I do think outside of the financials and small cap, you can find interesting things to play on a recovery thesis. Small cap consumer discretionary sector looks extraordinarily cheap right now and should benefit from kind of a recovery going into 2024. The same fundamental tailwinds that we would see in the big cap names, but the large cap consumer discretionary stocks are actually extraordinarily expensive right now. So we think there's a better risk reward in those small cap consumer names. I do, though, think, Lisa, as long as markets are kind of jittery, and as long as markets are focused on, kind of getting ready for Fed cuts down the road, I do think that tech is going to have some tailwinds. Now, we are watching the positioning there very, very closely. The NASDAQ futures are starting to get elevated. When that breaks, when that peaks, it's going to take down the tech stocks for a little bit. It's going to, impact the broader S&P 500 as well. But for now, I think the earnings trends are good. I think the Fed trajectory in terms of where the market expects to go is good. So I think you can be selective in small cap, but I do think that the tech space and big cap should do pretty well.
Laurie, you're not bearish. I just want to be upfront about that. You're really not. You've been constructive in some ways, in many ways, over the last few months. Laurie, how hard is it to convince someone to take money out of money market funds and put it in the equity market?
I think that it depends on what part of the market you're talking about, the time horizon you're giving investors, and the purposes that it's supposed to achieve. So one of the things we've been talking a lot about lately is the energy sector, which has really, really nice dividend yields, balance sheets that have been cleaned up. It's been kind of an orphan sector for the last few years. It's come back over the last year or so, especially with Russia-Ukraine in the spotlight. That's a pretty easy conversation to have with investors right now, even though there's some shorter-term concerns about oil prices. I do think at the end of the day, one of the things we see retail investors do is come into the S&P 500 for yield opportunities. And even though the growth sector, the growth part of the market is zigging and zagging right now in terms of, just all the strength we're seeing on earnings, there's some really interesting yield opportunities if you look at other sectors. Those aren't tough conversations to have, frankly.
Laurie, thanks for being with us. Laurie Calvert there of RBC Capital Markets on a broader equity market that's faced down some decent earnings over the last week from the likes of Microsoft and Meta as well. This from Mike Gapin of Bank of America going into the Fed meeting on Wednesday. Enough juice for one more hike. He says the handoff to 2Q looks soft. He goes on to say, we expect the Fed to hike by 25 basis points next week, signal a pause in June with a weak upward bias for rates going forward from here. Morgan Stanley have said something similar. Lisa, they've talked about this conditional pause they expect the Federal Reserve to communicate on Wednesday. I guess my question would be conditional on what?
Right.
After securing that deal with First Republic. Here are some of the headlines for you. All regulatory approvals received. The transaction has closed. They'll make a payment of $10.6 billion to the FDIC on First Republic. Another headline for you. The FDIC will provide $50 billion in 5-year fixed-rate term financing. Within this PowerPoint presentation, Lisa, there's just a plate that essentially reads the rationale for the deal. Accelerates key growth opportunities, increases penetration with US high net worth clients, accelerates US wealth strategy by adding JPMorgen wealth centers at attractive locations, complementary to JPMorgan Chase's #1 business bank, financially attractive, high quality portfolio, they say, with additional protection, strong credit profile supplemented by FDIC loss sharing agreement, loan portfolio marks supported by due diligence process, maintains JPMorgan Chase's fortress balance sheet, all those buzzwords, bit of PR in the mix as well, contributes to rapid and orderly resolution. First Republic depositors will be backed by the strength of JPMorgan, least a lower cost and most efficient option for the deposit insurance fund. Our capabilities and capital strength enabled a competitive bid.
And a little bit of detail with respect to the loss sharing agreement, saying that the FDIC will provide the agreements with respect to single-family residential mortgages with 80% of loss coverage for 7 years, and then with commercial loans, including commercial real estate, of also 80% loss coverage for 5 years. The key question here is, how do the financials work? How much will the FDIC basically be taking on a lot of the losses while allowing JPMorgan to profit from the interest that they get every single year?
Just